And India's growing commercial real estate sector also in focus. Mindspace Business Parks REIT, a real estate investment trust, reported a mixed set of earnings. Net operating income grew over 5% on year in Q2, but net profits slumped 11% at the same time owing to higher expenses. The REIT is expanding its data center portfolio, which is a big thing in India now, to tap into the growing digital infrastructure demand in India. In fact, I'm pleased to say that we are joined by the man behind the business, the management of Mindspace REIT. Ramesh Nair is CEO of the business, joins us right this moment. Ramesh, lovely to have you on the show. Thank you very much for your time. First up, how would you summarize your results, which seem like a mixed bag?
Great to be back on your show, Tanveer. Our results last quarter was actually quite strong. Revenue is up 6%. Distribution, which is the most important criteria to be looked at, that's up 7.5%. NOI is up 5.1%. This is the first time our distribution is crossing 3 billion Indian rupees, where our NOI crossed 5 billion Indian rupees. We also saw our occupancy go up by 60 basis points to 91.7%. In the last quarter, we also signed 3 build-to-suit data center leases, which takes our occupancy of data centers to 1.7 million square feet. Gross asset value today again increased to 313 billion, and over the last 1 year we have given a total return of 25%, which includes distribution.
How's commercial real estate and the returns thereof shaping up in the region, Ramesh?
The markets have been doing exceptionally well, Tanveer. YTD gross, again we saw a record 53 million square feet of gross absorption, net absorption of around 31 million square feet. Quarterly gross absorption last quarter was close to 20 million square feet, net absorption around 12 million square feet. This is a year-on-year growth of close to 19%. This is the second best ever quarter that we saw. This year is expected, the market is expected to touch close to 70 million square feet of gross absorption. Well represented, foreign companies around 56%, Indian companies around 44%, global capability centers within that foreign companies close to 36%. What we saw was also vacancy levels had dropped close to 16% now from the highs of 20% during COVID. Major trends which we are seeing, a lot of demand from global capability centers, tenants preferring institutionally owned assets. Physical occupancy has gone up. Our attendance rates have touched 74% in our portfolio. All the 4 markets where we have a presence have grown. We are seeing 2 to 3 million square feet of quarterly absorption in those four markets. Leasing decisions, again, what we are seeing, the overall timelines, we've seen that becoming faster due to occupiers becoming more certain about their businesses. So overall, markets doing very well, Tanveer.
Right, and I wonder whether the cash flows are strong enough to continue to deliver on dividends, which has been a very attractive feature for REITs in the region. I'm looking at some of your competitors as well. Even for your REITs year-to-date performance, you've gained about 13%. Embassy REIT has done about 20%. So what's the differentiating factor, and how are you looking to enhance shareholder returns, especially total returns?
Very simple. We need to keep increasing our occupancy, which increases our overall revenues and NOI. Like I said, distribution's up 7.5%. Since listing, we listed in August 2020, we've given close to 45 billion Indian rupees in distributions, which is a very healthy number. And we hope to continue this kind of distribution growth going forward, Tanveer.
I also want to get your sense on how much does the real estate market really depend on rates going down? Because unlike the rest of the region, rest of the world, the RBI has not embarked on its rate easing cycle. And even if it does, many are expecting it to be very shallow, at best another 75 basis points from here. And so is that really likely to move the needle for the real estate space, commercial or residential?
Definitely, Tanvir. RBI kept policy rates unchanged in the October meeting. Like you rightly said, the experts feel there could be rate cuts in December or in March from 50 to 75 basis points. Lower rates will definitely reduce our borrowing costs. It helps give us new refinancing opportunities. There are a lot of investors who also look at who seek steady yields. The REITs will help attract those kind of investors, and also the savings from reduced interest payments will translate to higher dividends. So lots of benefits. We are all looking forward to interest rates coming down.
Okay. And Ramesh, a final question. What do we watch out for over the course of the next 6 months, especially that we are going through a festive period in India? So Q3, Q4.
Overall, all the asset classes are doing well, Tanvir. Residential markets are doing well. Retail occupancy, retail revenues, again doing well. Office, what we're seeing is an all-time record. New asset classes like data centers, again doing well. What we have seen is over the years, even if there is a slowdown in the US, most companies look at setting up more global capability centers in India to cut costs in the US. IT services have been a little slow over the last few quarters, expectedly. So their occupancy absorption levels have dropped a little bit, but domestic companies and the global capability centers have compensated very well for those for that slowdown in the IT services.
Thank you very much, Ramesh, for joining us and giving us your perspective on your earnings. All the very best for the future. We have just enough time, do we? Okay. Asian markets have been mixed, with Japan hogging all the limelight. And that story will be taken forward by Capital Connection right here on CNBC coming up on the other